Nehemiah, welcome back to the show.
Yes, thank you, Owen. It's great to be here.
It is great to be here, recording again in Melbourne in the studio. And today we're going to be talking about Term Plus at greater depth because we had 20 or so people give us feedback on the previous episode because they were really interested in everything we spoke about, from private credit writ large to Term Plus to this whole world, and in particular Term Plus providing kind of like a portal or a gateway into that world for income. So this is going to be really fascinating for people that are interested in income, how you derive that through Term Plus. And if you haven't already checked it out, there is the first discussion where we talked big picture, innovation, building the platform and everything that you've done. You don't need to have watched that or listened to that to get a lot from this episode. So first things up, I wanted to ask you, and the community wanted to ask you, this comes from Casper and Jason. Generally speaking, when we think about private credit, we think about good sources of income. We think about this frontier, mostly for Australian investors. It's like a relatively new thing. In the US, it seems there's much more breadth and understanding around that. So can you maybe talk to us about where you think Australia is on that maturity kind of adoption curve of private credit?
Yes. Okay. So I think the first thing I'd mention, in the US and Europe, the industry's been around for a lot longer. And it's really been driven by the fact that, banks had disincentives to lend to various large segments of the market as a result of what happened in the GFC. Okay, and I can go back into it now, but you can watch the previous episode.
Previous one we spoke about it.
Okay, so if we use that as a starting point, Australia didn't have the same set of circumstances. Okay, same regulation, but our market is structured very differently, and as a result of that, what's happened is the banks here hold most of the credit. Okay, so I think by hook or by crook, by really good regulation, by APRA, by really good risk management at the banks, you have a very different set of circumstances. Okay, that's the first point. The second point then, in relation to Australia, if you said that 90% of all credit is intermediated by banks in this country, then the 10% that's not, will typically relate to where the banks don't have risk appetite, or they're not getting the right return for the risk that they take. Okay, and that's why you'll find it's concentrated predominantly in three types of assets. It's commercial property, subordinated positions, and asset-backed securities vehicles. Now, so if you think about your Liberties or Bluestones, the non-bank lenders, Latitude and Consumer Finance, they will loan money to consumers, but their financing structure will be, they'll have equity at the bottom of the vehicle, and on top of that will be bank financing and subordinated financing.
Yeah.
Okay, for the most part. And there's exceptions to all of this, so I'm talking 80-20. Okay.
Yep.
And then the third category is sort of loans that are syndicated by banks. They tend to be very large. They'll be the large high profile PE transactions. They'll be maybe smaller than that, but syndicated. Okay, meaning a bank will work on behalf of a borrower. They'll find the lending and they'll actually syndicate off the risk. They'll hold a bit of it and they'll split it up into pieces. Okay, so just broadly speaking. So those are the three areas that make up the 10% of the lending market. Very important, because those are areas of the market where there otherwise might be market failure. People won't be able to legitimately find credit for legitimate things to do. And so private credit plays a very important role in that context. So, and if you then said, okay, well, what will happen in future? Well, you see the same phenomena of, say, will the NAB Business Bank all of a sudden have half or more of what it currently has on its balance sheet provided by the private credit sector? I would say I think that's highly doubtful, because it would take some very significant change in the amount of capital APRA would have them hold against that book. I think there's a lot of implications around the efficient intermediation of capital. Banks are very, very efficient, at raising money and then lending that money. I think the kind of scale and the risk management systems, et cetera, that are there for that, I think it's very hard to unwind those economics in a way that would cause the banks to say, this isn't good business.
Yeah.
Okay. So that said, I do see there's still great opportunity in private credit to start to do more direct loans to people, not just through asset-backed vehicles, because a lot of people still value, and this is common across all jurisdictions, still value convenience, flexibility, speed, confidentiality, okay, and are willing to pay a premium for that.
For sure.
So I think you'll always have those edge cases, but the structural drivers that you have in Australia for private credit aren't the same as what you find offshore as a result.
I guess maybe it's like not as people aren't exposed to it as much. So when we talk about like the portfolios that you construct and how you put things together, how do you think about what would be, say, the true risk for people? So if that's kind of like a broad strokes view of the industry, but people are always thinking, well, what's my downside first? Or at least we encourage people to think downside, then upside, not the other way around. But when you think about constructing a portfolio, how do you think about the concept of risk and how you kind of pick and choose where the money goes on behalf of people who use Term Plus? And I know that's a very broad question, but we'll drill down after that.
Okay. So I think the starting point is when you're in credit, right, what you want is you want to be assured that you're going to get paid your income, right, the interest payments, and then you want to get your capital back.
Yeah.
Right. So we are a fund of funds, right? So, or a multi-manager. So we invest money in different managers, right? So we have 20 managers, 21 funds that we invest in, over 2,000 loans in that portfolio on a look-through basis. That's important because that's about diversification. But let me step back. So you want to get paid back and you want to get paid your interest. So, and you get no real upside, right? So it's all about managing downside. So the first thing that you want to do is you want to make sure that you find really good managers. Okay, and that's where we work with Mercer. Right, 16, 17 trillion of assets under advice. They manage multi-manager funds on behalf of large institutions. Right, long track record of doing that. They are global, so they're in every major global location where you find private credit firms. They actually assess and rate those firms for investment purposes. So they're not a rating agency. They're an investment business that rates funds for investment, and we only invest in their top-rated funds. Okay, so what does that mean? That means the managers will have a long track record of performance, and they've shown that they can manage to performance through dynamic economic or macro environments.
It's not like something new for them.
No, not like something new. They have to have a history and track record of performance in their given credit strategy.
Yep.
Okay. And within that credit strategy, they have to show that they have appropriate differentiation. Okay. So they originate deals on their own. Okay, they don't take term sheets from somebody else. They actually originate most of their deals, and they will then underwrite those deals. They have widely diversified portfolios so they can minimize risk of loss overall and maximize the return. And they have really good portfolio management and workout resources. Meaning, so portfolio management being constant assessment of how are each one of the underlying loans, how are they going against original plans?
Yep.
Right. And if they go off track, they have conversations with the company immediately because you never want them to default.
Yeah.
You want to work with the company to kind of cure any issues before they even occur.
Yeah.
Okay, from a contractual perspective. And then not everything goes right? And so you want workout resources that have proven experience to actually minimize loss if things go wrong. Okay. So it's really important that manager selection, and we use Mercer for that process. Okay. Now, the next level, so let's say you do that with every individual manager. Then you say, okay, well, do I want to take single manager risk, business risk, or performance risk? So business risk, they might lose a whole bunch of key people. Performance risk, for whatever reason, they don't perform. And now you've invested in something, depending on the format of the fund, you've invested something that maybe you don't get your money out easily. If it's a closed-end fund, if it's open-ended, you might be able to redeem out. But you are now taking single manager risk. You redeem out your money, where are you going to put it? If you want to put it in the asset class.
Yeah.
You then go through this whole process again of finding a manager, diligencing, et cetera. Okay? So the first thing is we partner with Mercer in order to do that, and we are multi-manager because we believe you shouldn't take single manager idiosyncratic risk.
Yep.
We are global, US and Europe, right? So we're not concentrated in market. We're not concentrated in industry. Everything about our portfolio is about diversification. Okay, so that's really important because that's how you minimize single point risk. You minimize propensity for loss.
Yep.
Okay. The other thing I'll say about a manager that I think is really important that also goes to the assessment is alignment. Okay. So with private credit managers generally, and then I think for top rated managers, even more important, there's a number of things that I think should give investors comfort, which is the alignment point. And what that is a fund manager or a private credit manager holds each loan to maturity. So they have to get paid back in full. They don't trade it. Okay, so they don't go and originate and earn fees distributing credit.
Yep.
Okay, so because I've got to hold this until it gets paid back in full, I'm going to live with that decision.
Of course, yeah.
So number one, I'm going to be very selective. And that's why they're all skewed to, I always say, like really boring companies.
Yeah.
Very defensive, non-cyclical industries, so business services. So my business services colleagues, I'm not trying to insult you, healthcare, but healthcare services, consumer staples. So things that basically don't move around because you really want certainty of income. Okay. So selectivity is into industries that demonstrate those characteristics with companies that have, very repeatable income, typically quite variable cost structure. So you have the ability to cut costs if you need to maintain cash flow, strong industry position. So you have pricing power, so you can pass on extra costs, low CapEx or high fixed cost bases, because, if revenue starts to suffer, you don't really have, much room to move to kind of pay you back. So these are the kinds of things a really good manager will look at when looking at whether they will lend money to a borrower. So the selectivity rate, would be single digits, low single digits in terms of, 2 to 5% conversion rate of the things that come in. Okay. The other thing that's really important is how you manage that loan through to, like I've talked about before, right? And then finally, you have a fund structure that's widely diversified. So say no individual loan, whether it goes wrong and you write it off, will have any real material impact on the portfolio.
Yep.
Okay. So just by virtue of how we select, how they do business, what's inbuilt in how they underwrite, the wide diversification of the portfolio, right? That's your first line of defense. Okay. I forgot to mention one other thing, actually. Sorry. For senior direct lending funds, it's all senior secured. The LVRs are 30 to 50%. Okay, so you have a lot of cushion or a lot of equity cushion under your loan, and you have those contractual protections that I talked about before. So you add all that up. For something to blow up, you need, quite a systemic thing to happen, and that has an immediate impact that turns off people's revenue overnight to have a material impact on the portfolio. Okay, so that's the first thing. And then if you go to Term Plus, well, we've got, as I said, in our master portfolio, 21 funds, 20 managers, over 2,000 loans across different types of strategies. And the income that's then earned on all of that forms the basis of the income that we pay out to investors. Okay. And for every dollar that we get from an investor, we invest 5 cents of our own capital. Now, we're quite happy to put 5 cents of our own capital in there because we actually like the asset class, so we're quite happy to take that risk.
Yeah, of course.
Okay, number one. Number two, we do not get paid any income on our capital unless we pay all of our investors their income and their capital. Okay, so I don't know a lot of managers who will say, I'll take zero return on my capital, right? On the basis that, well, I'm paying everybody first, right? So I say that because, we put our money where our mouth is on this, and we want to earn a return on our capital.
For sure.
Okay? And so we really do things to ensure, and I encourage everybody to look at the PDS and read through the protections, and the PDS provides a lot of like some numerical examples to help people understand the protections that are in place. But I think the bottom line is that capital helps to supplement, the return on that capital helps to supplement or reduce the risk that you won't get your income and reduce the risk that you could lose your capital, forgetting about the way the portfolio is constructed to minimize that happening in any case. Does that make sense?
Yeah, no, that was really good. You laid the frame really well there, because for folks that are listening, we'll walk you through this, but on the Term Plus website, so obviously there's a lot of information, particularly, I think I said this to you last time, the How It Works page is really, really great. But I guess the thing that, and this is where a lot of the questions come from, is if someone lands on, say, the homepage and they see a 1-year account 6.85, 2-year account 7.5, 5-year account 8, right? People would be comparing that to a range of different options that they might be able to put their capital into. And the first thing that comes to people's mind is like, well, 6.85 and 7.5 is like some people's expectations for the stock market, like the equity market, right?
Yes.
And so the natural question is it too good to be true, which we did talk a little bit about last time, but maybe what falls out of that is like the 1 year is 6.85% per annum, right? And it says underneath that, it says RBA cash rate plus 3%. So people, like, I'd be comparing this against a bunch of other things that I'd be like, well, I could just park some money here, here, or here. This is well above anything else that I would get.
Yes.
Like, how do you construct that portfolio to make sure that I will get my 6.85%?
Yes. So the starting point is, as I said before, with the number, we have 20 managers, 21 funds, different strategies across that, and different return profiles. Okay. So our portfolio is live. Okay. Because when we take $1 and we're investing into that portfolio of managers who deploy the capital. Okay. So when you think about it that way, we kind of already know the returns that we're getting. And so the first thing is, what are the returns we're getting? The second is, for the different term accounts that we have, 1 year, 2 year, 5 year, there's a different liquidity requirement, meaning, okay, when you provide us with 1 year money, it's locked up for 1 year. Now, you can send us a letter and request getting it out early, but for us to manage the liquidity, meaning the ability to pay you back, we need to know the money's going to be in there for a year. That's why it's locked up for a year. Okay? So our starting point is, okay, what's the liquidity? We know the return. What's the liquidity profile? Number one. And making sure we're generating enough income to be able to then make our distributions to our investors. Okay? Then the second thing is, which is where, say, the duration comes in, is there's 2 types or 3 types of funds we invest in from a liquidity perspective, but I'm going to make it simple and say there's 2. Okay? Because an evergreen fund's in the middle. So there's really the 2 bookends. Okay? It's open-ended means money comes in every month. I can invest in the manager every month and deploy the capital, and then they'll start to pay me interest every month or every quarter. Okay, they can vary. The other type of fund is a closed-end fund, which is generally what they call accumulation funds. Okay, so those are funds that might have a life of anywhere between 5 and, say, 10 years. Okay, and it means when we invest in those funds, what will happen is they'll have a minimum that you have to commit. Okay, so let's say that's $1, and let's say it's a 10-year fund. They might have 4 years to call that $1 from you. Okay, so you've committed $1. As I find opportunities, I'll say,
hey, okay, I need that money now.
I want 25 cents today, and that will fund some of my investments. You have to make sure, I'm going to give you a 2 weeks notice. So you better make sure that you have that $1 sitting in cash or something that you can give me the 25 cents when I call it. Okay. So I do that over a 4-year period. Now, what happens is I take that, I start to invest. I take it, I start to invest. And the returns from those investments will accumulate within the fund. So think about it as compounding within the fund. So some of them will pay a little bit of yield, but for the most part, you put your money in, it can invest it over 4 years. In years 5, 6, and 7, they'll start returning your capital back, and you'll get an internal rate of return or a multiple on that capital.
Yep.
So let's say it's 1.2 times or 1.1 times. So the cash flow profile is something like if this was above the line, below the line. So they'll start to take the money in and it goes like this, right? In terms of money into the fund. And then it comes out like that. Mm-hmm. And your return would be something like, if that's the line, it might be below because you're sitting there and you're paying me fees on the capital before it's been deployed.
Yep.
So your return profile will be slightly negative and then it'll go like that.
Yep.
Does that make sense?
Yeah.
So our portfolio is made up of, you just make contractual income. You give me money, I invest it in that month, I get interest, and others that accumulate. So with a 5-year account, that dollar will be invested in a little bit of both. With a 1-year account, it's very likely all of it will be in our income generating funds. But there's a blended amount across the funds that we invest in that has regard to the returns that we need to earn, the interest we have to pay, and the liquidity requirement for people to redeem or to get their capital back. And so that is how we invest in our master portfolio to then deliver on those individual RBA plus 3%, RBA plus 365 for 2-year, RBA plus 415 for 5-year.
Yeah.
Does that make sense?
It does make sense. So then another question that our community have is, obviously they're all very diligent and look at the PDS, like you said. Yes. And one of the things that they pointed out, which is great, is that basically Term Plus gets paid, and this is my gist, so you can correct me where I'm wrong.
Yes.
That Term Plus gets paid when you achieve your 6.85 or whatever it is that you're going for. Effectively, that's when you start to get paid in a meaningful way.
Yes.
Right? So can you talk a little bit about then your incentives as the firm that manages this? Like if I come into something and I want 6.85, they could Charlie Munger quote, tell me where I'm going to die and I won't go there.
Yes.
But incentives are powerful, right? So what is driving you guys to make sure that I get my amount of money?
Okay. So the first thing here is, we in the Pengana credit business, we manage a number of different products that come off the same sort of master portfolio.
Right.
Okay. So, and I say that because I think it's important in the context of answering the question, what's our whole reason for being in the first place? And then how does that then link into how we structure this product? Okay. So the first thing was, it's a very difficult asset class for people to be able to access unless you're a very large institution like the Future Fund or the industry super funds who are all investors in this asset class.
Yes. Okay. Yeah, we talk about that a lot.
For all the selection, all the things that I said before about how we go about it, that's really hard to do for an institution, let alone for an individual.
Yeah.
Okay. So the whole reason for being is how can we democratize the risk return trade-off that you actually get from the structural opportunity in the US and Europe. Okay. That's why we set up the business. Now, when we go from there, the next thing is in establishing Term Plus, which is called the most democratized access. We wanted to make sure we did a couple of things. Number one, I guess as Pengana, we're well known in institutional markets, we haven't been a real retail type business. So our name recognition and Mercer's name recognition, not great. Yeah, okay. But the underlying asset, fantastic in consumer markets. Okay. Yep. So we wanted to make sure that when we're offering these income products, that when we launched it, not only did we make it easy to invest and provide the education, et cetera, we also wanted to make sure that people felt, secure, what's the right word? Confident, right? That what we were actually doing, that it's legitimate.
Yeah.
Okay. So the first driving force outside of the democratization is the fact that we only live and die by the success of our products overall. So our whole reputation and what we deliver and the quality of what we deliver, super critical. Okay. So then you get past that and you say, okay, so what's really the use case for investors and how do you make it a democratized access? That's why the minimum is 2,000, because we wanted to make it easy for people to be able to invest if it suited their needs. Right? There's no use making it 20 or 40 or 50 or whatever, because that then excludes and it doesn't really democratize it for a very small subset of our community that can invest. And I think I told you last time the reason why the internal discussion that we had about why it was 2,000.
Yeah.
Okay. And it was about unit economics at the end of the day. I wanted it as low as possible for that reason. Okay. So, so what then follows, and the other thing is, in order for that security, in order for that confidence, that's why we invest our own money. Okay. So when we invest our capital, we want to get it back now, and we want to get the return on capital. What's really important about our capital, two things. We do not get paid any income return on our capital until all of our investors are paid their income first. And it's a dollar unit price because it's not participating. So you're not getting the return of the fund, you're getting the return for the time period.
Yeah.
Okay. So in that time period, we want to ensure that if for whatever reason the unit price of $1 goes below $1, well, we have to top up that dollar before we earn.
Yeah. Okay.
Okay. And the final piece about it is we look back 12 months. So what that means is on a rolling basis over 12 months, the income earned actually goes to pay the income that we owe to investors and to top up to that dollar over that term before we get paid. It's not just so
it's
for
not just
example,
like today.
It's not just okay. We made 10% this month. We pay 3% out. Now talk spread. We made RBA plus 10 this month. We have RBA plus 3. We pay out. We earn RBA plus 7. That's not how it works. We earn RBA plus 10 over 12 months. And for all the investors across each one of our term accounts, we have to pay all of that income on a look-back basis. So every month we're looking at what's the profit that we actually have to pay out, and it's paid out of the total pool.
So it's like now, you look back at the promises that were made.
100%.
Yeah, right.
Okay. And so, so that's retained capital. That's not capital. That's capital that we're entitled to if we meet all of our promises on a rolling 12-month basis.
Yeah.
It's not like this month we made it, next month we don't, so we pay less. This is real economic risk that we're actually taking. And that's why I say the confidence and the alignment with the investor is so high and our conviction on the product. Okay. So earn out of the portfolio, managers take their fee. So net of the fee they earned is what comes to the fund. We then go through and say, okay, we have to pay 1 year money, 2 year money, 5 year money. The income that we look at, is there anything below $1? We have to top that up. And then what's left is what we earn, but it has to be retained for 12 months on a rolling basis.
A question for you. I've got two questions about the product specifically. One, has this become more in demand recently with interest rates falling in Australia?
Yeah, so we've got a lot of inquiry with that happening, but I think more broadly it has.
Yeah. Okay. Yeah, it's hard to discern what's just growth and what's,
but the other thing I'd say is, I'm a user of our products. Okay, so I'll tell you the calculus that I went through.
Yeah, sure.
Okay, so I sold our sort of family home at the end of last year, right? So Monique and I, my wife, we're trying to work out, okay, well, we're going to want to get back into the property market, we think, at some point. We're not 100% sure. So at least not right now. So in having that and wanting the optionality, we're thinking, well, we're not going to invest it in anything that has volatility, because if you want to go back in the property market, we had to make sure that we had capital preservation.
Yeah.
That was primacy. The second was, I did not want to keep it in a cash account at the bank because I wasn't earning anything from it.
Yep.
Okay. And term deposits, great, they're guaranteed, et cetera, but not earning enough interest for what we wanted. And then, for me, what I love about our product is I'm an investor in all our products. And so, for what I wanted with capital preservation, I looked at other income funds as well, but none of them had the, I didn't want Australian correlated risk, meaning.
That was actually one question from the community as well, for what it's worth. Yeah.
Okay, right. Because I go, well, pretty much every fixed income product based in Australia is in some way, shape, or form correlated to the same risk. Okay, so state of the property market, because there's a lot of property-based investments, right? Yeah. And the banks on their balance sheets hold tons of property. The state of the economy at large, the unemployment rate, so what's actually happening, and the state of rates, because a lot of it's floating rate linked to the RBA rate with the spread. So I said, well, whilst we hedge everything back to an RBA plus, right, because people want,
certainty.
US dollar, they want certainty of capital, you don't want volatility. That's why we hedge it back. But the bottom line is, I wanted to diversify where I got the return from. So if you think about how many people, 25 years ago, everyone had domestic equities, probably very few people had global. Now you wouldn't find any portfolio constructed that doesn't have both.
Yeah.
Okay. And I think the same thing about this asset class.
Yeah.
Okay. So when you go through the calculus, you say, okay, where can I get the kind of spread, the kind of risk reward trade-off that you get out of a private credit portfolio where there's a lot of these barriers that make it very difficult for an individual to be able to invest? Well, that's why we created the product, to create that ability to diversify your income stream on a risk-adjusted basis. And because we were new and not known in that context, we wanted to provide that additional level of security and alignment, because we couldn't provide a guarantee.
Yeah.
Right. And it's fixed term because it's for a very specific type of use case. So if you're like me and you want the capital preservation and, I'm in 1 year, I didn't want to be in 2 years because you might
buy again.
Who knows?
Yeah.
Right. And so I wanted the optionality, and a year was easy, and thinking about, okay, in 6 months, I really have to determine whether I want to roll it, or 3 to 6 months before the end of the term.
Yep.
That's plenty of time for me if I was going to buy a house to make that decision and know I can get the money out.
Yeah.
That makes sense.
Yeah, for sure it does.
Okay. Is that helpful? Is that answer?
No, yeah, it
okay,
is.
Great.
Can people so I'm looking here on the website, right? So
Yes.
I can click reinvest my income or pay to my bank monthly. Could I have multiple accounts, like multiple investments, so to speak? Because the reason I ask this is, this, like a lot of wealthier people, a big part of what their income strategy is rolling TDs. Like they'll have a TD that rolls off and then they have another one next month and so on and so forth to earn better income than a typical savings account.
Yes.
So I'm thinking, I'd imagine you'd have people that want to have, like they're happy to lock their money up for a year, maybe 2, maybe even 5, right?
Yes.
But they would probably, if they had $100,000, they probably wouldn't go all in one. Or maybe they do, but some of them would want to stagger maturity dates just to add a little bit more flexibility, if you know what I mean.
Yep,
can you do
100%.
that?
Yeah, 100% you can.
Yeah. Okay.
So you have to, each one is an individual account.
Yeah, okay.
Okay, but you absolutely can. It'll take you, opening an account for me took 2 minutes.
Right.
Right. Maybe 3 minutes. It's very simple and easy.
Yeah.
Okay. And so it's very easy to get the 1, 2, and 5. And you have the option of whether you want to take cash or whether you actually want it to compound and get the whole lot paid at the end. Okay. Right. So there's a DRP and there's, or you can take it as cash income every month.
Okay. Cool. You mentioned before, and I've got a question here that came from Jason Price in our community, who asked a question about what actually happens when the borrower defaults. So you mentioned that $1 unit price before. Is that what that reflects? It's kind of like if that goes below 1, then someone's defaulted. Is that kind of what the gist is? Yeah.
So for that to happen, yes, it would represent an impairment.
Yeah.
Okay. But the way of looking at this is, so you have an individual fund. Okay. So let's just take one fund, forgetting about the fact that we're diversified. Okay. Yeah. So you're in one fund, and let's say that fund has 500 individual loans. And within that fund, and remember, in these senior direct lending funds, you already have the diversification by number. You have the security. You have the information rights. So you're seeing it every month. You're getting involved early if something goes off track. And you have workout resources.
All those protections that just
all
kind
of those things,
layer in there. Yeah.
So you then say, and let me give you an example. So there's a company, I'll give you the type of companies that, people look at here. So, one of the loans in our portfolio with one of our managers, this company is a leader in the US for kind of regulatory signage.
Right.
Okay. And what does that mean? So, stop signs.
Right.
Or, think about the COVID signs in hospitals.
Yep.
Okay. So they are a market leader in that. They have built a technology platform that allows people to procure online, so they don't have to have salespeople. Now you just go on and you order online.
I want 10 stop signs.
Right.
Yeah.
And so very high customer retention, very predictable earnings, non-cyclical. In fact, the need is growing for these types of compliance signs, believe it or not.
It makes sense. They're everywhere.
Right. So that's the kind of company and the loan to that company was done at about a 38% LVR from my recollection. And within that context, and the interest rate would have been about 11%. Okay. And they were using it to consolidate and continue to invest in growth of the business as they transferred everything online. Okay. So that's so what has to happen for that, the 30, that LVR, say on average, let's say 40%, what has to happen when you have a bunch of contracts, a bunch of repeat business, et cetera, for that revenue to diminish.
Yeah.
Okay. Or for the cost to blow out. Who knows?
Yeah.
Something happens.
And then you got all the equity capital alongside
So then I, as a lender, I'm going to be having these conversations. If you're the company, we're going to be talking about this right at start. What's going on? You're not performing. How are you going to fix that performance? We need you to fix that performance. And ultimately, I can take the keys if I want.
Yeah.
Right. I can keep the customer list, which is the asset. I can sell the customer list in a receivership, or I can sell the company. Okay. So there's all of those things that have to happen. And this has to happen across thousands of loans.
Yeah.
Okay. So think about $1, and the return of that fund will be the income plus some there's a little bit of accumulation. Okay. So let's say the fund's earning 10%. Well, you need all that 10% of income to disappear, and you need all the security to disappear, right?
Yeah.
But firstly, the income. Okay. So if I go from a net return that goes to zero or negative, that's ultimately what's going to impair the unit price in the way that the unit price works. Okay. And you need that to happen across a mass. That's why I say for that unit price to change, you need something quite cataclysmic across
everything
to have a substantial
geographies, industries.
Because remember, there's the returns, right? There's the overall, if it's got to be negative, the returns have to be negative, so sufficiently negative that you're going to have that type of unit price change. Okay. That's how this works. It's different to, if you invested in a different type of private credit fund. So we have a listed vehicle as an example. You still have the income return, but then the net asset value for the fund based on all of the net asset values of all of our funds will dictate so the NAV could theoretically move, right?
Yeah.
But it doesn't mean the income's gone.
So what you're effectively doing is you're packaging up the income.
Yes, we're packaging up the return of the whole fund.
And then providing the income.
Correct.
And you guys are effectively saying, like, we know what's going to happen.
Yes.
Like to a high degree of certainty.
100%.
Yeah. Okay. And you guys get the income, and we're going to weather the risk that we don't perform.
Correct.
Yeah,
and our capital, when you think about it in that context, everybody's capital is at $1 here.
Yeah.
Because you're not participating in the income of the whole fund. You're getting a subset of that. And in return, you get the protections. In return, you get your money back on a shorter duration.
And then the longer arc of this is Pengana / Term Plus gets the benefit of managing the money for decades to come.
Correct.
And your profits accumulate because you're doing well as a result of that.
Correct. And we always have to retain enough profit in the fund to make sure that we're meeting those things that I said before. We're paying your income, we're paying your capital up to one up until maturity. If that makes sense.
How big can this get then?
So I don't see a constraint in terms of our ability to deploy capital.
Right.
Okay. Because this is a structural thing in the US and Europe. The fund selection always remains critical, but the industry is going to continue to grow rapidly. I mean, any major player in it, any major research firm in it will talk about the ongoing compound growth that you will see in the industry as assets come off bank balance sheets, as banks start to partner with private credit operators because they don't want to hold the credit, but they want to originate it, want to keep the fees and the relationships, all those types of things. It will continue to grow, in my view, for a very long time. So we're not really capacity constrained. So I'd say our growth will only ever be constrained by our ability to ensure that we have sufficient liquidity to meet our yield payments to investors on a monthly basis, and to ensure that we're able to pay back the capital at the end of the term, which is about liquidity. So that is how I think about what our constraint is. It's really that.
Yeah.
And that's not really a constraint unless, say, you had a whole bunch of individuals put in massive amounts of money on 1 year that they're going to take it all out at the same time.
Yeah.
So in one day we had, 500 people put in 100 mil each.
Yeah.
I don't think we'd be taking all that money because in 12 months' time, we're going to have to pay all of that back.
Yeah.
Okay.
That makes sense.
And so it's harder we can do it, but the rate, it would probably be a different rate. So it'll be dictated by liquidity things, not by the capacity to deploy funds. Does that make sense?
Yeah, no, it does make sense. I've got so many questions, but we are actually recording this after 5 p.m. and I know you have a family at home. So I've got, if I can, a couple more questions.
Sure.
So you mentioned your use case.
Yes.
how would someone position this? And maybe you have data of people that are already using it. Maybe because I'm thinking like,
Yes.
Can you have a family trust account in this?
You can have self-managed super. Yeah, you can have family trust. You can have children. So every single category that exists from a tax office perspective, yes, can invest.
Okay, because that's like this type of thing for
and
like
that's
family
the beauty
trust.
of building. Sorry to interrupt. It's the beauty of building something using online tools.
Yeah.
So if you think about, I remember years ago when I was at NAB when UBank was done.
Yeah.
Right, it was the first time you could do identification, open an account within a couple of minutes.
Yeah,
Right, and put in and have a deposit. Well, we structured it this way because it gives us a lot of flexibility in adding different features, making it easier for different circumstances for people to get through. And we also have a chatbot and we also have a call center. So if somebody has a problem going through the website, they can call us and we can help them through. And we built it specifically. When I say democratize, like this is very well thought through. The whole experience of going online and opening an account, we wanted to make as simple as possible. Right? After you've done all the work to make sure it's suitable to you, you then can do it very quickly and easily. It was structured specifically to create ubiquity of access. Right?
Yeah.
And I told you, I'll tell the story. I told you a story before about my own self-managed super. So when I went, because I have a self-managed super investment, not just a personal investment. And when I did it, I had a tax file number that was 8 numbers. There's not a lot of self-managed super funds around that have that. And so I had to go on the chatbot, and then we actually worked out how to call my administrator. And we then did the development to make sure that we could take 8-digit tax file numbers on super funds.
Yeah.
Right. And if you do that, you can sign up with your super fund if you have the details in front of you within sort of 5-10 minutes.
That's remarkable.
Yeah. So that's the great thing about using online and direct.
Yeah. Okay. So then the other question, I mean, I've got a lot of questions here, but like, I feel like a lot of people would be using this as those kind of, you know, I guess the question is that it comes back to a lot is like, because of the way the rate is structured.
Yes.
Does it mean that as interest rates come down, that folks will
the headline rate will come down. With the RBA because
they're floating rates, those underlying and stuff like
that.
The
spread that you earn over the RBA rate is fixed.
So that's the 3% for that 1 year.
So RBA plus 3%, 6.85 today.
Because then you can match that on the back end to what you reasonably assume.
Correct. Well, what we do is we ensure in how we price each one of these things, we're always ensuring at the outset, we know what our portfolio is earning.
Yeah.
Okay. Unless there's some cataclysmic event, like I said, we know what the portfolio is earning. We're not going to run a fine margin.
Yeah.
Right. Like we want to run a business. We have to retain our profit for 12 months on a rolling basis. So we want to make sure we always have adequate spread to cover what our obligations are. And we do that on a look forward basis. We don't do it on a, okay, well, it's what's going to happen today. We actually do it on a look forward basis because you have to manage your liquidity that way. Right? Because you have a maturity profile. You have different maturities of term accounts and you have different liquidity coming out of the fund. Remember I said closed-end funds with accumulation, open-ended funds.
So that's your juggle.
Yes, we have a combination of different types of terms of our own closed-end funds. We have some that we invested in 3 years ago.
Yep.
Right, to get that clock ticking. So we'll have capital coming back and being harvested in the next 12 months.
Yeah.
From the early ones. Does that make sense?
Yeah. And so from an end investor's perspective, they're thinking, well, if I want to get one of these longer dated ones, and I'm worried about rates keep coming down. Because these are like the people that we speak to are like worried about that, right? They're rolling
totally
off CDs. Like it's good for people that have mortgages, but for people that are saving and in retirement, they're looking at it being like, well, you know, for most people that listen to the show, the accumulators, they're like not worried about rates falling. But if you're in retirement, you're going from 5%, 4%, 3.5%, you're like, wow, that's a lot of my capital.
100%. And in this context, it's sort of an inflation-proof investment.
Yeah.
Okay, because as it, you know, if you were there in 2020, you know, and you really wanted capital preserved income and you saw all those returns eroded with a product like this, you wouldn't see that. Okay, because we managed to that. And the underlying assets are floating rate as well.
Yeah.
And they earn higher spreads. So when we hedge, we're basically hedging, we're effectively locking in the spreads we earn in our portfolio.
Yeah.
Okay. against what we pay out. That's effectively what you do when you're hedging it. So so I'll give you a few different use cases. I'll give you my use case, but we have 5-year investors, and I'd say, with at least 2 of them that I know in those 5-year accounts, it's simply retired, capital preservation, want the income, don't want to worry about it. And so it's in there to earn income on a monthly basis. There's plenty of other investments you can do that with, but they just wanted that higher return, and they felt at 4.15 or 4.15% over the RBA cash rate relative to what their needs were, that worked out great. My daughter's saving for, a trip she was going to do overseas. So last year she started putting some money into Term Plus, right? Because it'll come out at the point at which she's going to go overseas, and she wanted to turn as much as she could so she'd have her spending money. All right. So I think there's a myriad of different use cases that basically go to, I want secure income, or my daughter's case, I want to compound the returns that I have so I had more money at the end that I can take on my holiday, right? So many different use cases, that low, $2K minimum, that nice spread that we actually earn from our portfolio that we can see, right? So when we're investing into a fund, we already kind of know how the fund's performing in these open-ended funds. They're 3-year duration, broadly speaking, portfolios. So a third rolls every year. You know what's in the book.
Yeah.
Okay. So you sort of have quite good certainty. We've locked in that spread. So that's how we determine how we do the 1, 2, and 5 years, and the spread we need to earn, and the liquidity, like I said, which is a key thing that drives it. So, we know all of that. We make it really easy. We put some defensive mechanisms in. We're highly aligned with our investors in what we do. So we don't want to lose our capital. We want to earn a return on capital. And of primacy, we all value our reputations and what sits behind us. So we want this product to work, and we think it's a great product. So all the reasons why we've constructed this thing the way we have are all about ubiquity of access, different use cases, et cetera, I guess is the point.
This is more of a business question. I know we're going to come to a close in a sec.
Yes.
Because I'll put links in the show notes and YouTube description for everyone that wants to go check out Term Plus.
Yes.
Create an account. It's free to create an account, if I'm not mistaken.
Correct.
Yeah.
Correct.
Business question is surely, I feel like as a long arc of financial everything over the next few years, packaging up things like we see ETFs in equities, right? Like packaging up things really well, and providing the transparency and access to traditional strategies that would be out of touch for people.
Yes.
We talk about private credit a lot on the show, and it's a bit of a buzzword, and there's stuff, and people say it's things like there's risky elements of it, and sure, that's why you've got the pedigree here. But I guess my question is more of a business question, is why would a big institution or other partner institutions not look at what you guys are doing with Term Plus and be like, well, we could white label that? Because I feel like this is going to be super attractive to other big places in the future. I feel like this is beyond just everyone here on the podcast getting a slice. Do you know what I mean?
Yes. No, I totally get what you mean. And so what you'll find is, I think we have some use cases in that context.
Right.
Okay. And you'll see that we have products in our pipeline are absolutely of that ilk, because we're like a one-stop solution.
Yeah.
Right. And the way I look at it is, okay, if you're a very large institution like an industry super fund, you've got plenty of internal resources. You have a very long time horizon. You don't really care about liquidity.
No.
Okay. So, there's how that's constructed is quite different, I think. When you're dealing with more wealth platforms and facing more into, call it retail for want of a better phrase, then the liquidity requirements are quite different, and you have to care a lot more about it. There's a lot of people who don't have the resources to construct multi-manager portfolios. So what I think is what we've done is we've created a platform, and I hate using buzzwords like that and tech, but really we've created a platform that allows a one-stop shop for anybody who wants diversified access who, if you believe in diversification, diversified access to global private credit.
Yeah.
And we also, in the way we constructed the master portfolio, provide the ability. So think about like Lego, if you want to use that as an example. You can put it together however you want. So if you said, okay, I want to put 5% of my portfolio in diversified global private credit, I want it all accumulating.
Yeah.
Okay, and I want a much higher return profile, like more equity-like. Okay, well, we can construct something with the right size. We can construct something that delivers that.
Yeah.
Okay, so I feel like you come to us and say, we want to be in global private credit. We want the diversification. We don't want to have to administer it ourselves, because believe me, administering these things, okay, like be careful what you wish for. You invest in 5 funds, you're going to have different rules for how you put money in, money out, it is a total pain, and you can't necessarily turn it all into one automated process.
Yeah.
Okay.
Yeah.
So when you put all this together and you have that done, it's just really, okay, tell me what you're using it for, what sort of return you want, what sort of income distribution you want, what sort of overall return that you want, and we can construct something. So I think more and more, as people get more educated on the asset class in the non-institutional space or in the small institutional space down, I think they'll find that there is we can pretty much do anything for anybody.
Yeah.
Right. And then it really comes down to what's the size, and is it worth us for us to construct something on a bespoke basis? Yeah,
other than like everyone that just listens to the show and comes and invests, how much is it worth? You guys getting distracted by something else. But yeah, I just think it's like, we talk about this is a lot. It's like people getting access. What you're proposing is simplifying this whole thing that people have been outside of for a very long time.
Correct. So you get all the attractive things of it, right? Yeah. Attractive income, low volatility, really good capital preservation. You have really high capital efficiency because we take the capital, we deploy it immediately earning.
Yeah.
There is no J curve that they say in close. Right. So your capital is invested immediately. We manage all the liquidity. Okay. Yeah. We hedge it, and we do all the administration of it, and then we do all the reporting that you need for it.
Yeah.
Okay. And you get that sort of in one investment. So I kind of go, knowing, reason I don't have any hair. Well, you heard the story why I don't have, but reason I don't have any hair, I can, if I want to say in jest, is, it's not easy to construct something like this.
Yeah. Yeah.
Okay.
Yeah.
The partnerships.
I can imagine.
Right. All everything that was required to do this is not easy.
Yeah. Yeah. No, it's cool. Well, mate, I hope that a lot of people go and create an account, because if only just to check out how it works, particularly now with rates coming down and people being really mindful of their income, compression of yields on equities and different types of things. Like, there's more and more reasons to consider this.
100%.
And there's plenty of literature on the website, which I'll direct people to. And who knows, we might even have to do a round 3, mate, because it's something that I'm just fascinated by, and I know you are too. So
I'd love to do it anytime, Owen.
Yeah.
Like, we schedule it, and no mix-ups, and I'll welcome the opportunity.
I really appreciate you sticking around after hours to do this with me, because I could just keep talking for hours about this, because I think it's fascinating, both from an entrepreneurial sense, but also what it does for investors. So no, mate, I really appreciate this. So thanks for taking some time to share more.
No worries. Thanks, Owen.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.